Welcome back to the Wealthy AF Business Brief, where we break down the headlines that matter for entrepreneurs, investors, and builders of generational wealth. I'm your host, the elite strategist, Martin Perdomo, and today's global news has direct implications for your wallet, your deals, and your strategic moves. Home Depot is struggling. Demand for big ticket purchases are slipping. All eyes are on Fed Chair Jay Powell's final Jackson Hole speech. Rate cuts may be coming, or he may pump the brakes. And finally, the S&P just reaffirmed the U.S. AA+ credit rating, betting that tariffs revenue can compensate for recent fiscal expansion. Whether you're repositioning portfolios or watching for the next big policy signal, this episode is for you. Let's break it down. Home Depot just missed expectations for its second quarter earnings. Net sales clocked in at $45.28 billion, just shy of the $45.36 billion analysts forecasted, while earnings per share came in at $4.68, slightly below the $4.71 estimate. What's behind the miss? The consumer is pulling back from large renovations. Homeowners are favoring small do-it-yourself maintenance projects over financed big-ticket upgrades like kitchens and bathrooms. This makes total sense. As home demand slows way down, construction slows way down. Just total sense. If you listen to my real estate market update last week, you'll know that real estate is in a slump right at this moment for house sales. When house sales slow down, there's a direct correlation with Home Depot slowing down. Home Depot's foot traffic fell 2.2% year on year, and CEO Ted Decker says the deferral mindset is still in play. Tariffs are beginning to bite too. Some products, particularly imported goods like garden chemicals, will see modest price increases, he said. Still, the retailer is remaining to keep most pricing steady thanks to diversifying sources and more than 50% domestic supply. So I can tell you from personal experience, we are remodeling a huge project right now, also owning a construction company in Pennsylvania and running construction crews. They are right. And we source most of our product through Home Depot. We haven't seen a big price increase much of our products. We saw a little brief of a price increases in appliances for a short while. I'm going to say from January to like March or so. And then we went right back down to our regular pricing. So I think that was more so of the scare of the tariffs and all of that stuff, but we got our pricing back. For investors, if you're exposed to cyclical or big ticket retail, reinforced strategies around consumer prudence and rate sensitivity, Home Depot results signal caution, not collapse, but clear headwinds for discretionary spending. Now, like I said, if you're watching the data, you expect this. Like Home Depot executives know this, right? You see housing demand dropping. You see not a lot of hot purchasing power. They correlate with one another. This is what happens. This week, all eyes are on Jackson Hole. Jay Powell's speech may indicate whether rate cuts are imminent or Fed is steering cautiously ahead. Markets are currently pricing in an 83% chance of a 25 basis point cut in September. Now, the markets are doing that. JP Morgan Chase had a 94% chance. Now the markets are saying 83% chance. And the truth of the matter is, we need a bigger cut, Jay Powell. We need a 50 basis point rate cut so you can really get things moving again. We expecting with up to 5 cuts expected through 2026, but there's pressure. Treasury Secretary Scott Bessent and President Trump want much more aggressive easing. Hey, so do I. From 150 to 400 basis points. Me too. I'm with Bessent and I'm with Powell. I'm a through and through real estate investor. I'm a through and through entrepreneur. We need lower rates. We need it now. I'm in real estate. We need it now. The market needs it. Businesses need it. Families need it. Americans need it. You're paying more on your credit cards. We need it now. Jay Powell. I'm with DT, Donald Trump. You're too late. Always too late, bro. You're too late and you're too late again. You need to cut rates now. That is 100% my opinion. It's my podcast. I can give my opinion. Jay Powell, cut the interest rates now, brother. You're hurting us. Everyone warns that if Jay Powell doesn't deliver dovish cues, markets could slide 7% to 15% this fall. Elevated equity valuations soften job data and inflation uncertainty make Jackson Hole a potential inflection point. Powell, I'm not going to say more on this. Cut the rate, bro. Just give us 50 basis to 75 basis points is what we need right now to start getting things moving again. Powell's tone here could make or break the short-term market. A cautious stance might shake investors' confidence, for sure. A clear dovish shift could re-anchor expectations of sustained easing either way. Have defensive or selective growth positioning ready. In a surprising twist, the S&P reaffirmed the U.S. sovereign credit rating at a AA+, citing strong tariff revenue as the key stabilizer against new fiscal expansion under the One Big Beautiful Bill Act. I love that bill because there's a lot of advantages in that bill for entrepreneurs, for Americans. Actually, the average American no longer pays taxes on overtime. There is no more taxes on tips and wages. Yeah, there were some things cut. Thing is this, guys, if you learn if you educate yourself on this bill, you can take advantage of it. The problem is most people aren't educated. They don't educate themselves on the bill, so they don't know how to take advantage on it. If you're a real estate investor, I want to give myself a quick plug here. I actually studied this bill and created an ebook. If you go to my IG to @TheEliteStrategist and you go to my homepage, there's a link there that you can download this ebook on how you can take advantages. The advantages for real estate investors if you're investing in real estate. I make it real simple, real plain Jane vanilla, simple for you to understand. I give you real life examples on how this could work. It's real simple. Go check it out at The Elite Strategist on IG. Tariffs this year have contributed significantly, estimated to add as much as $2.8 trillion in net revenue, offsetting some of that additional spending. Yet, caution remains. Persistent deficits already exceeding 100% of GDP and political instability could threaten the U.S. fiscal health if the Fed's independence is compromised. S&P explicitly called the Fed's autonomy the best defense against a downgrade. So basically, the S&P is suggesting that the feds need to stay independent. I don't know if I have a thought of how I feel about that. I suppose it's a good idea to have the feds independent. Just sometimes I just don't agree with the feds moves, even when they lower rates too much and too hard and too fast, right? Jay Powell back in if you've been listening to my podcast, you remember in 2021, Jay Powell, he committed to not increasing rates until the end of 2024. Lies on lies. This is why you cannot believe what these guys are telling you, and you have to be studying and paying attention to what they're doing, not what they're saying. Because look at where we are. He started increasing the rate in January of 2022, and yet now here we are, 7% rates for mortgages. Like he doubled the freaking interest rate in a year. So lies. And I understand he had to adapt in real time as inflation was. I get all that, but still, you got to pay attention to what they're doing, not just what they're saying. I'm watching both. I'm watching what you're saying, Jay Powell. I'm watching what the politicians are saying. And I'm also, more importantly, watching what you are doing. Take note, investors, fiscal risk hasn't gone away, but markets see tariffs revenue as a temporary balance. If deficit assumptions shift or the Fed loses credibility, the outlook could change fast. Keep duration risk monitored. To recap, retail is still moderating. Home Depot missed signals continued caution amongst consumers. Fiscal health has a short-term buoy, but long-term risk remains. If you're serious about building wealth and real strategy, come hang with me on Instagram at The Elite Strategist. I'm breaking down in real time deal flows, wealth building plays, market tactics that we don't post anywhere else. Plus, you'll get access to the Wealthy AF newsletter, my free deal analyzer tool, and early invites to our private investor events when you go to the link in my bio and you sign up for that. Check it out at wealthyaf.media, and let's get you positioned to win now. Stay sharp, stay informed, stay focused, because the future looks super bright. Peace out. This is the Wealthy AF Business Brief. Later.